Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, welcome to this new episode of Through the Noise. I'm your host, Heung, Senior Investment Strategist in the CIO office. And today I'm very happy to join by Raymond Cheng, our CIO in the North Asia, to share insight with us. Welcome, Raymond. And in this weekly, we said that the chance of Fed rate cut in December meeting has actually improved. Can you give us a quick recap of the reason why and also what is the implications to the risk assets?
Sure, Ray. After the October FOMC meeting, we've seen a seesaw in Fed rate cut expectations. At one point, the expectation of a cut was lowered to 30%, but now it's back up to 80%. The increase in the odds this time has been partly driven by the dovish remarks from New York Fed President Williams. Williams commented that a slowing job market and easing inflation risks call for another rate cut in December. The Fed's Beige Book also indicates a cooling job market. With the delay in the official jobs and inflation reports for October and November until after the December Fed meeting, policymakers will likely have to rely on the latest Beige Book survey to assess the health of the U.S. economy. The Beige Book showed the labor market remains in a low hiring, low firing mode, with employers focusing on replacing workers rather than adding to payrolls. Many firms are finding it easier to hire, a sign that labor shortage is reversing. This is mirrored in the private sector data, which shows a decline in job openings and rising layoff announcements. Rate cuts, combined with solid AI-driven corporate earnings growth, should sustain a risk asset rally into year-end, in our view. Nonetheless, prudence warrants a barbell strategy to global equity allocations, given concerns about valuations in the US and sustainability of the AI-driven rally. We remain bullish on the high-growth tech sector while scaling into the US healthcare sector, especially pharmaceuticals. We also remain globally diversified with a preference towards China equities, given earnings growth there picks up sharply in Q3.
Thanks, Raymond. I want to drill into a little bit more on the US equity side. We have been suggesting a barbell approach, as you said, with the focus in tech and also in healthcare sectors. Would you be able to give us reasons why you think the high valuation in tech can sustain, and do we have a preference in the healthcare segment?
In the US tech sector, particularly within which the semiconductor subsector, we expect valuation to stay high despite growing competition in advanced chip making, as demand there stays very strong. The US chip makers continue to make the most advanced chips for AI applications. Excess demand has led to strong pricing power, resulting in lucrative profit margins. This is the key driver for significant R&D on advanced chips in the US. Major tech companies that are buying these chips have the resources and incentive to develop their own chips in order to lower their cost over the long term and also provide some sort of self-sufficiency reassurance given the supply shortage. Now, these alternative chips may not have the best performance, but they just have to be good enough for the specific purposes for the company that are developing them. Hence, we expect further growth in application-specific customized chips. Now, the valuation of the semiconductor sector has been rising from pre-COVID years through to post-pandemic and ChatGPT launch years. Valuations may pull back somewhat when growth tapers off, but the strong demand there can sustain elevated valuations, in our view, for the next 6 to 12 months. Now, in terms of the healthcare sector, we are overweight there, and we suggest adding in changes given increasingly crowded positioning there. Now, within the sector, we prefer pharmaceuticals given receding regulatory headwinds and solid long-term growth prospects. The U.S. healthcare sector's composition is split between pharmaceuticals, biotech, and life sciences, which combined account for 60% of the sector, where the remaining 40% belongs to healthcare equipment and services. We expect the pharma and biotech sub-industry to be the primary growth driver, and we project 12.4% earnings growth in the next 12 months, above the broader sector growth of 9.7%. Whereas the healthcare equipment and services subsector is expected to deliver a more moderate earnings growth outlook. Regulatory risks are also receding for large-cap biopharma, with government deals on tariffs and the expansion of Medicare and Medicaid coverage for innovative therapies like GLP-1s serving as key positive catalysts. From a valuation standpoint, the sector's recent strong rally has led to crowded investor positioning and elevated valuation. However, it's still trading at around 15.2% discount to the broader US market, which is lower than the 10-year average of 10.8% discount. We therefore suggest investors add in tranches to capitalize on this potential re-rating.
Thanks, Raymond. Over this middle of the week, we have the UK Chancellor of Exchequer announce the autumn budget. How does this budget affect our views on the pound, the government bonds, as well as monetary policy? Maybe also on the FX side of the equation. Can you also give us an updated view on New Zealand dollar after the recent RBNZ meeting?
Sure. On yields fell after the UK budget announcement, with the 10-year and 30-year yield falling by 7 basis points and 11 basis points respectively. Now, we feel this reflects the removal of any previous concerns about the UK budget, as well as the projected reduction in long-maturity bond supply. However, we believe interest rate volatility will persist. The budget introduced 26 billion British pounds in tax increases, with the Chancellor highlighting an improved fiscal buffer of around 22 billion British pounds till year 2029 to guard against unexpected shocks. The buffers are largely back-end loaded, though, and it will also hinge upon the UK economy to demonstrate higher growth to ensure sustainability. Therefore, we view the 10-year yield at 4.4% as near-term resistance. Markets have priced in a higher likelihood of a Bank of England cut in the upcoming December meeting. Challenges such as sticky inflation, despite recent moderation and fiscal sustainability concerns, will hinder significant further downward movements in yields. Now, on the FX side, the Office for Budget Responsibility expects only a modest near-term impact on growth and projects inflation to return to the BOE's 2% target by year 2027. Together with a more anchor inflation outlook, this should support the British pound against the dollar. The pair looks poised to break above the 50-year moving average, the 50-day moving average, and test resistance at around 1.34. Now, in terms of the New Zealand dollar, we turn bullish on the New Zealand dollar against the US dollar near term after the hawkish RBNZ cut. The pair is likely to test resistance at 0.58. The RBNZ cut the official cash rate to 2.25% on November the 26th as expected. However, it signaled the easing cycle may now be over. The domestic economy is showing clear signs of stabilization there. Export-led sectors such as agriculture continues to benefit from resilient commodity prices, while there is firming consumer demand. Together with rising business confidence, as we expect more Fed rate cuts into year 2026, and therefore a widening of policy divergence, that should support a rally in the New Zealand dollar against the US dollar.
Thank you, Raymond, for your insight and sharing. Unfortunately, that's all the time we have for this episode. Thank you all for listening to this episode of Through the Noise, and please stay tuned to our next episode. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.